Shares of Warner Brothers Discovery soared more than 15% on Thursday after the media giant said it would separate its declining cable TV business from its streaming and studio divisions. The move sets up a possible sale or spin-off of the company's lagging legacy networks, which include TNT, Animal Planet, and CNN. Under the new structure, those channels will be housed in a unit called Global Linear Networks. A separate division will merge streaming platforms Max and Discovery Plus, as well as premium channel HBO, with the company's film studios, which include Warner Brothers Pictures and New Line Cinema. Warner Brothers Discovery, which shed 9% of its cable subscribers in the third quarter, is not the only media company exploring options for its TV business. Comcast last month unveiled plans to split most of its NBC Universal cable networks into a new public company, while Comedy Central owner Paramount Global had earlier this year agreed to merge with streaming-era upstart Skydance Media. Warner Brothers Discovery CEO David Zaslav had engaged in merger talks with Paramount late last year, though a deal never materialized, according to a regulatory filing. Zaslav said recently he believes deal-making will improve under the incoming Trump administration. Warner Brothers Discovery expects to complete its restructuring plan by mid-2025. U.S. stocks closed lower on Thursday as investors evaluated key economic indicators ahead of the Federal Reserve's policy meeting next week. The Dow and S&P 500 each lost more than 0.5%, and the Nasdaq shed more than 0.6% to dip back below 20,000, a milestone it crossed a day earlier. A Labor Department report showed U.S. producer prices rose more than expected in November. While markets are still pricing in a quarter-point rate cut from the central bank next week, Christopher Carey, portfolio manager at Carnegie Investment Counsel, said Thursday's data may have muddied the picture on where the Fed goes from here.
This is definitely, a data point in the wrong direction. And I do think there is maybe just a little bit of nervousness with market participants, especially if you consider the run that we've had in the market, not only this year, but over the last couple of months.
Stocks on the move Thursday included Adobe, which plunged nearly 14% after the Photoshop maker forecast fiscal 2025 revenue below Wall Street expectations. Shares of Warner Brothers Discovery soared more than 15% after the media company announced plans to separate its declining cable TV business from streaming and studio operations. And Nordson slid more than 8% as the dispensing equipment maker forecast fiscal 2025 revenue below Wall Street estimates.
Britain's economy shrank for a second month in October in the run-up to the new government's first budget. That's the first back-to-back fall in output since the onset of the global health crisis in 2020. Data shows gross domestic product shrank 0.1% month-on-month in October, as it did in September. Economists polled by Reuters had forecast a monthly expansion of 0.1%. The services sector flatlined, and output in manufacturing and construction industries declined in October. It adds to a run of worse-than-expected figures for Britain's economy. Business surveys and retail sales are also falling flat. The country's finance minister, Rachel Reeves, says the focus is on policies to deliver long-term economic growth. Her budget statement in October imposed large tax rises on businesses, but raised investment and spending on public services. Last month, the Bank of England trimmed its annual growth forecast for this year to 1% from 1.25%, but it's predicted a stronger 2025. It expects growth of 1.5%, reflecting a short-term boost to the economy from Reeves's big spending budget plans. Britain's economic output has grown slowly since the global health crisis. Only Germany, which was hit hard by surging energy costs after Russia's invasion of Ukraine, has done notably worse among the largest advanced economies. For the fourth time this year, the European Central Bank has cut interest rates, this time by 0.25 percentage point. It kept the door open to further cuts as growth is hit by political instability at home and the threat of a fresh US trade war. ECB Chief Christine Lagarde.
We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path.
The ECB has been easing policy as inflation worries largely evaporate. The debate has now shifted to whether it's cutting rates fast enough to support an economy that's lagging global peers. Predicting that inflation will be back at its 2% target in early 2025 and that growth will remain sluggish, the ECB lowered its deposit rate to 3%. It also changed its guidance, likely to be taken as a hint of further rate cuts. The ECB's earlier policy statement had omitted a previous promise to keep policy sufficiently restrictive. Some say this signals a return to at least a neutral setting that neither stimulates nor slows growth. But this signal was less forceful than many economists had expected, especially as it came with a warning that domestic inflation remains high. The ECB warned downside risks remain, with Germany facing an early election, France struggling to find a stable government, as well as President-elect Donald Trump threatening punitive tariffs.